Nike shares are trading at 52-week lows, and this has a lot of our subscribers asking if there's value to be had here, or is there a value trap? So today we're going to take a look at that. Now, I wanted to start by talking about Nike's brand. I can recall when early on in my career, I was working for a startup and we had a project manager come in from Nike. So he used to work there, and he told me how, at least back in the day, Nike never had chairs in their conference rooms, and that was to force everybody to have very quick meetings. So I used to adopt that technique with my teams in my corporate career. And Nike, as you can see here, has a very powerful brand that everybody knows. If you said to somebody you worked at any of these companies, they'd know right away what they did. Now, when we look at why Nike is so well known, one of the reasons for that is that they're advertising all over the place, particularly in sporting events. And here you can see some of their most notable athletic endorsements, Jordan being at the top there. And of course, Tiger Woods. If you're following golf at all, then you would remember one of the greatest shots ever made, and that was when the Nike ball sat on the lip of the cup for 2 seconds before rolling in and flashing the world the Nike side. And before that night was out, Nike said they made the equivalent of roughly $1 million in free publicity from replays of that clip. You couldn't have hoped for anything better. So when we analyze Nike, we want to look at what exactly they do, why there's softness in the stock, to see what recent news is relevant. Is it short-term or systemic problems that may affect long-term investment thesis? Is the dividend safe? I don't know. I certainly didn't know. Nike has been increasing their dividend now for 22 years in a row. They're going to be a champion soon. And what key metrics should we be watching? And there's quite a few of them, actually. So here's a look at what happened to Nike stock, and this piece here by the Oregonian says Nike stock has worst day on record, wiping out $28 billion in value. The shares tumbled 20% after the company said it expects sales to decline in its new fiscal year. So that would be this coming year. It was the biggest one-day drop in Nike history, so it garnered a lot of attention. And this article refers to it as the latest sign of severe turbulence, implying that there's some historical reasons why the stock has been dropping. Indeed, we'll look at that. Now, the CEO is relatively new, John Donahoe. He's bet heavily on direct sales and the popularity of Nike Classics, and that move away from wholesale has opened shelf space for competitors. Now, in the most recent earnings call, the CEO and CFO used the word comeback 5 times between them. So this is becoming a comeback story, not something that we like to see. But what was quite alarming was how the CFO was surprised at what he saw in terms of the macroeconomic environment. This company should have its finger on the pulse a bit better, and they're expecting mid-single digits, so let's say 5% decline in the coming year, versus analysts expecting 2% increase, so let's say a net 5% decline in sales. This is what a 5% decline in sales looks like. You can see that on the right here in that red bar. So it's hardly the end of the world. When you look on the left, you see quarterly revenues do appear to be somewhat stagnating or plateaued. Analysts are really concerned about execution, and particularly around Nike's direct-to-consumer pivot, which didn't pan out. So in 2017, Nike decided to sell directly to consumer. And if you think about this, prior to that, they were selling to wholesalers who would then mark those products up and sell them to customers. Well, if you sell directly to the customer, you can capture that extra profit. Then you can see that here in this diagram. So this is taken from their financials. You see total Nike brand revenues. That's somewhere around 96% of total revenues. The other bit would be Converse. So they have, of their total revenues, they've broken this down to show what it would look like if direct-to-consumer was wholesale. So the difference between the two is the value they're capturing by going direct-to-consumer. And then below that, it's interesting here, they show a breakdown of the gender of sales here. Men's are what, half, and then you have women's, children, and the Jordan brand. So this is an interesting segmentation, at least when they break down those wholesale numbers. But Nike initially zeroed in on direct-to-consumer because they were confident that customers would buy directly from the brand if given the choice, and that would allow Nike to hold on to more profits. Well, it didn't work out so well. So when they implemented that strategy, they slashed a number of retail partners. We were thinking about this. It's hard to imagine why you would do that. If you thought customers were going to go to DTC, you should have left your wholesalers and then just started pushing DTC. If they switched over, big deal. But they actually cut partners and said, listen, we're not going to sell, almost forcing customers to go to DTC. They built out 5 global store concepts, again, direct to consumer, digital and bricks and mortar. And what they found is that they underestimated the power of wholesale, where shoppers are looking for the best deal possible, and they're not that loyal to a particular brand. And I hate to bring up anecdotal evidence, but I found the same thing myself. I used to be a Nike runner for a long time, and then I switched to a different brand for a number of reasons. But one of them was that I couldn't really seem to find Nike in the stores that I used to go to. So they've been slowly adding more wholesale players back into the mix. They re-entered partnerships. So that's not very good when you break a partnership with somebody you're working closely with and then you re-enter it, right? It shows you made a big mistake. And this other bullet point here talks about how Nike had alerted investors to reduced wholesale selling in the first half of fiscal 2024. So it shouldn't be a surprise to see this decline in revenues. But look at these two pieces here. It says Nike moves away from Foot Locker in shift to direct to consumers. That's in 2022. And then look at a year later, Foot Locker touts renewed Nike relationship as it reports slide in holiday quarter profits. So again, this what they call a pivot is actually a reversal of their strategy, which didn't work out so well. So when we look at Nike's key metrics, such as sales across various geographies, we see 43% of sales coming from North America, interesting 15% coming from Greater China. As I said, Converse 4%, Nike 96%. Of that 96%, 68% is footwear, 28% apparel, 4% equipment. And emerging markets, where, especially in the case of like Ronaldo, sponsorships like that are going to garner a lot of attention from people who are going to have money soon as emerging markets start to prosper. And one interesting thing, I call it the North Face problem. I've seen North Face manifest itself in every way you can imagine across this globe. And sometimes it's very obvious, sometimes it's not. But what I ended up concluding is that it isn't such a bad thing when you have counterfeits, because the people such as China, right, the people there who would buy a fake would actually feel like they hadn't made it whilst they're incidentally advertising that brand to all their friends. And when they do finally make it, hey, this is a real North Face. And everybody around them sees that brand, regardless of whether it's spelt slightly off or a fake or a counterfeit. So they still have a lot of brand. And those people who can afford to actually buy the real brand do. They don't just buy a knockoff and say, well, this is a perfect substitute. No, they actually go for the real brand in most cases. So when we look at Nike's key metrics, one thing to note is they break out their earnings before interest and taxes in these various geographies. I found this was interesting. So China's 15% of sales, but nearly 27% of profits. So perhaps they're able to command a price premium in China where, knockoffs, they still are to a certain extent, not as bad as it used to be, but you can find them all over the place. So how can Nike possibly compete against that? Well, they compete against that pretty well because they have a strong brand, and the Chinese who are able to pay for real Nike will proudly wear it and say, look, this is a real Nike product, right? So when we think about valuing Nike, so everybody's looking at, Nike's share price is depressed. There's value to be had. Well, relative to what? So we need to find a comparable benchmark. And what we can do there is look at the GICS classification, that stands for Global Industry Classification Standard, to find a peer set. Nike's classified under consumer, durables, and apparel. So MSCI actually has an index that tracks this industry group. And I could show you here on the GICS breakdown. You see consumer discretionary. So that's a sector that we're all familiar with. Well, under that, you have subsectors, what GICS calls industry groups. And look, one of them is consumer, durables, and apparel. And MSCI has an index that shows what that looks like. You can see that here. The MSCI World Consumer Durables and Apparel Index, and Nike's PE ratio is around 20. Compare that to the index of 19.4. So even at its current price, it's still let's say, right about around where it ought to be. So, the question you should ask, is Nike expected to enjoy more earnings growth than its peers? Well, it certainly doesn't seem like that's the case for now. But where Nike becomes quite attractive, I think, for long-term investors, and when you consider they're close to being a dividend growth champion, so they have 3 years left to go. And here you can see the stock price over time and the dividend yield. So yield is now approaching 2%. That's at a historical high. It doesn't seem very high, but it's growing quite fast. So when we look at the growth of Nike's dividend, they've had 22 years of consecutive payouts that increase over time. This is solid double-digit growth in dividend, a 22-year track record. They're going to be a champion in 3 years. So what we want to understand there is, are the current problems going to pose any issue for this dividend growth? We look at net operating cash flow here along the top, and then you can see cash and dividends paid. And let's take fiscal 2024, for example. The company returned approximately $6.4 billion to shareholders, including dividends of $2.2 billion, up 8%. So that double-digit increase, then it seems, has dwindled down to high single digits. But you see share repurchases nearly double that. So there's a lot of leeway there. Plus, they have $11 billion in cash for this equity bond to keep growing that payment. The company just needs to have a strategy and not only restore confidence in their ability to execute, but actually execute. And one problem that I noted here, the banter, you see this piece from Business Insider. It says at least 20 Nike executives have left the company in the past 3 months. This was in 2022. And I read that somewhere else where that new CEO coming on in 2020, there's two scenarios here. Either he's incompetent and all the competent people there are abandoning ship, or he's competent and he's seeing that a lot of these executives are rubbish and he's bringing in his own crew. Well, it's hard to say which is which, but there's potentially some more talent problems, at least how the market sees it. Nike's laying off 2% of its employees. That was announced earlier this year, cutting more than 1,500 jobs. And analysts here say management credibility is severely challenged and potential for C-level regime change adds further uncertainty, implying that they're going to do something about the CEO's inability to execute on that failed strategy. Though, to be fair, if they brought that strategy in 2017 and the new CEO started 2020, then he's just inherited that. So let's rehash what we've covered today. This is a future consumer discretionary dividend champion. I like that because we only have 4 in our universe right now. VFC actually was in our universe, and they lost their status because in looking at this space, there's been some turmoil across the entire space, VFC being one example of that. So Nike has a great dividend track record that appears safe. Their strong global brand seemingly has some temporary setbacks. That global DTC strategy didn't pan out so well, but it's pretty easy to reverse, right? Just go back to your ex-partners and say, let's partner again. They seem to be doing that. Wall Street was surprised, and so was management. You don't want management to say they're surprised by something. They're supposed to have control over what's going on and be able to predict to it, at least from quarter to quarter. They don't seem to have control, and they need a refreshed strategy. There's also no quarterly decks. I found that to be problematic. No general investor PowerPoint with a strategy. I always like to start with that when I'm analyzing a new company. They don't even have one. But the point here on the price, when you're thinking about value or value trap, there's probably value. There doesn't seem to be any systemic problems, but it could have room to fall. So if you invest with conviction, don't be pissed off that shares fall another 20%. Be happy. You can buy it even cheaper. That's a common sentiment I see all the time. People saying, oh, the stock price fell. It's horrible. Well, if you're buying the company, if you have conviction, then buy more. You should be really excited to buy quality names as cheap as possible. So when you think about Nike, ask yourself, what justifies a premium valuation for that stock? Is it the brand, right? Because it's certainly not the execution right now. So I'm going to go ahead and leave you with another video that we did. It's on why we prefer dividend growth investing strategies. It's quite interesting. Please make sure to subscribe, support our work, share our content with your friends and enemies. Thanks so much for taking the time to watch this today.